Yes, we can definitely start. Uh, so this is the presentation that I did a couple of weeks back also. It's on asset allocation, and a lot of you have been asking me about asset allocation and how we need to see things, and when do we rebalance. So if you guys have already been there on the previous asset allocation webinar, then this is not going to be helpful for you at all because it's almost the same content. So this won't help you. So you can still participate in the Q&A. I'm sure that a lot of you would have many doubts uh, after that webinar, and with the things that you've been reading, and now gold doing extremely well. So and we have done two webinars on gold mining and silver, and how that should be a part of your asset allocation. So do go to the Milestones2Wealth YouTube channel. If you just go to the live or the shorts section, you'll find, and just type gold, you'll get our webinars. And we've been giving active calls on gold and gold mining on Milestones2Wealth. If it fits into your asset allocation, definitely that would have worked for you. It's still going to work for you. So that is what asset allocation is all about, being in the right asset class at the right time. So what is asset allocation, right? uh, so according to you, what is asset allocation? If any of you have any answer, you can just put it in the comment box. I'll start off with that. What is asset allocation? That's my first question. According to you, what is asset allocation? You can put in your comment. Diversifying across various assets like equity, gold, debt. Yes, okay. Based on one's need and risk appetite, he or she will choose the percentage of asset. Perfect. I think that's the right answer. Right. Based on one's needs, doing what is best for you is asset allocation. Right. Knowing what your goals are, knowing the goals that are coming up for you, and how much risk you can take. Now, risk is very, very subjective. It depends on you. It depends on what your personality is, what your character is, how much. Uh, it's all based on your experiences to say, okay, this is the level of risk that I can take. This is what I can take in terms of volatility, and this is the amount of capital that I'm willing to see lose if at all anything bad happens. Right? So it is doing what is best for you. Right? Asset allocation does not mean that just because some other investor or some recommendation has come from outside saying that this much of asset allocation has this much of assets need to be there in that particular asset class. Let's say equity needs to have 50% or debt needs to have 20%. The others can be arbitrage and whatever said and done. And that doesn't work because it's not one size fit all, right? It's what suits you. Now, this is a very short question on what are you saving for? Why are you saving? Are you saving for your retirement? Are you saving for wealth creation? Are you saving for education? Or are you saving for traveling? Right. Ultimately, asset allocation has everything to do with why are you saving first in the first place. Right. If you are saving for a particular reason, put in your answer. Only then this is your need, right? Then we will start getting into how much risk does that particular need sort of require. Yeah, you're saving for retirement, okay. You're saving for wealth creation, okay. Again, there's a wealth creation, okay. Okay, there's a retirement, there's a wealth creation. Okay, so there's majorly a wealth creation and a retirement sort of a goal that's coming up. So that's a need. Okay. The need is I want to save money for my retirement. Second, I just want to build for my wealth creation, and then I'll take a call of what goal this has to get funded for, be it a retirement goal, be it a vacation goal, be it education goal, anything, right? So now, how far is that goal for you? Is it less than 6 months? Is it 1 to 2 years, 3 to 5 years, or more than 7 years? Most of you said retirement, so it has to be 3 to 5 years. Wealth creation, you have a long way to go. But how far is that need coming up for you? Seven years, 3 to 5 years. Somebody said less than less than 6 months. Okay, the goal is less than 6 months. 3 to 5 years. Okay, 7 years. Okay. Okay. So a majority of you have said 3 to 5 years and 7+ years. Right. Now, should this matter? Because one, your need comes up, and second, you have a time constraint in place, right? Market doesn't have a time constraint, right? Markets are they will continue to do what it has to do. They will long-term cycles will keep taking place, short-term cycles will keep taking place. But you have to think of your time horizon, and you have to think of what suits you, right? Now, this is what the Milestones to Wealth model is all about. Right. When we think of asset allocation, we don't see that, yes, this is the appropriate amount of percentage that you need to have. No, some cycles in particular asset classes are longer than the rest. Like for example, now, and this we have been actively talking on social media as well as on my webinars, that the opportunity that's coming up now, where there is no participation, there is a lot of turnaround that can take place, is more on the debt side, right? Where today we are getting included in global bond indices. Our macro is much more better than other global nations. Our inflation is very well covered. Our CAD is very well covered. We are continuing to have a good deficit. So that means that we are on a very good wicket, which means that we have to make, so for the next leg of growth that has to come in terms of capex, your debt markets need to be a lot more open. Your debt markets need to be a lot more transparent. Your debt markets, basically there's a lot more involvement that has to happen in debt markets, right? And your yield has to be priced properly. Your debts have to be priced properly. That only means that uh, in the cycle that's coming up for that, there is a good opportunity for you to make somewhere around 8.5% sort of yield on the debt side, right? What has happened on the debt side is why it has become so interesting is because on the contrarian, equity has become a lot more heated. Right? There's a lot of greed that is taking place in one particular asset class. By virtue of that, or not a lot of participation has been taking place on other asset classes like precious metals and debt. So one example for precious metals is that since 2018, it's one of the best gold has been one of the best performers since 2018. Right? If you date it back, naturally again, It has done extremely well. Again, in US terms, it has hit an all-time high. It breached $2,400, and this is one of those very interesting cycles where your debt markets in the US are pricing no rate cut. Your gold is pricing a rate cut, and equity markets don't seem to be pricing in a slowdown or no recession. So it's a very strange and very interesting market, right? But fundamentally, it works only as more greed and more fear, right? When there's more greed, you have seen this in small caps where there is extreme greed, that everybody is chasing performance, everybody is chasing in only one particular category between in that asset class, and you see a lot of money being going in, and you're foregoing future returns that are coming to you now, right? Long-term cycles will continue to take place and short-term cycles will continue to take place. Where you have to be in is to make sure that you are on the other side. When there is fear, you have to participate in that particular asset class, and when there's greed, naturally see where more incremental money can be added, right? It's not a switch out, it's not a switch in. This has nothing to do with moving from one asset class to another class, but rather when you talk about rebalance, it's not a switch out. When we talk about rebalance, is more to say that yes, I have taken advantage of this one particular asset class. Now I have to build more of my savings into asset classes that can help me protect my capital as well as preserve whatever I have made. Like, so you have to settle for something lower. You have to lower your expectation down. If at all you sorry, I think I, yes, I got cut off. I think there's some internet issue that I think my internet is acting up very weird today. So let me just present again. Am I audible now? Is the screen visible? Yeah, I hate it when this happens, when the internet starts acting out and I have to lose my flow of what I'm speaking. So if anybody can just tell me where I stopped uh, so that I can start back again. Was it this slide? Do you want me to start again with this slide and I'll start again with this slide? Yeah. your need that is coming up, you have to take active calls on making sure that you are in the right asset class at the right time. Right. So I was giving this example of how debt is uh, one of the very interesting opportunities in India right now, because our macro is very good. Our fundamentals on the macro side look very good. Our deficits are good. Second, your inflation is very well controlled. I think RBI has done a fantastic job in terms of controlling inflation. And we are getting included in the bonded assets. So you will see a lot of inflow coming in on the debt side, right? Again, we are going through a wave of private capex. Uh, Government is hell bent on making sure that this decade is going to be an infrastructure decade. So naturally, you will have a good mix of debt that's coming in. So debt markets are going to become a lot more deeper. Like debt markets are going to open up, and things will change in the debt market. So it obviously gives you that opportunity for you as an investor to take advantage. Now, when we talk about rebalancing, it's not a switch out from one asset class to the other asset class. It's building incremental savings that you have onto asset classes that can, one, because you're talking more about growth, adding asset classes that can help you preserve and sustain wealth creation. This is not a switch out from one asset class to the other asset class, right? And after that, you need a payout, right? This corpus is going to create is going to fund your monthly expenses. Only then you have to go towards, only then you have to consider switching and going towards asset classes where you can still make more than FD, uh, that can fund whatever expenses that you keep on getting. But if you have 7+ years or so, then you have to start building incremental savings into asset classes that can, one, if debt markets are more heated, then naturally it has to you have to look at other options with equity and precious metals. If equity is a lot more heated up and optimism extremely high, when you see a lot more people being a lot more greedy, naturally you have to look towards other asset classes, which means you have to be extremely contrary. Now, I'll give you an example of how going really can work for you, right? But first, understand these asset classes. Cash is only meant for you. You can have cash equivalents, your savings account, whatever it is. Adding additional risk to your portfolio, right? You need to consider gold and silver as an inflation hedge. It's a proxy. It's another currency, right? This has nothing to do with equity versus gold. You have to always consider precious metals to currency because it is alternate currency, right? Back in the day, it was even before gold standard came in, everything was pegged to gold, right? Because it is an alternate currency, it was all pegged to gold. Even right now, you're seeing some countries starting to peg back into gold. You see Zimbabwe wanting to go back into gold. They have extremely high inflation. They can't do anything about it. So they have to, and they have rebalance their currency base multiple times. So you're seeing, non-developed or slowly developing, last stages of developing, that is all at the bottom of the developing chain. Countries also starting to go back to the gold standard, right? But gold has to be considered only as a currency proxy, right? Then comes your fixed deposit. And fixed deposits and your debt is not meant for you to take risk. It is only from a safety perspective, settle for lower returns that is coming in, because it is not meant for you to take risk, right? It is meant for capital preservation. It is not meant for growth, right? So when you think of debt, you don't think of debt as, yes, this is going to help me grow my wealth. It's supposed to preserve your wealth, preserve whatever uh, you have been able to do in your wealth creation journey. So if you participate on debt for a couple of years, you are not going to miss out on anything because you have a longer term horizon to take advantage of. Right. Then comes your real estate. I think real estate is more of an emotional and financial stability. One interesting question that we keep getting is, when do I actually start buying real estate? Right. One way that you can think of when you're looking towards buying real estate is to first have a stable base of savings. That is, because let's say if you're young, and you are getting into this habit of saving, you're doing your SIP, and you build a very good base on which your savings are going more towards equity as an asset class. Like you've taken advantage of equity, and whatever you're able to make from equity, that can be used for your real estate. So first, always look to build a savings base, build a habit, because real estate is a very big commitment also, right, on the wallet, right? You can't commit unless and until you know how things work, and of course you need your savings to make money, right? So you use uh, equity as an asset class to build a proper base for your savings, and only then look towards building your emotional security needs. That is more real estate, whatever has to come with that. But I would suggest that yes, first I think you should look towards building a strong base and only then going towards overcommitting, right? If at all there is a particular case like that. Equity, of course, if you have a longer term goal, 3 to 5 years is considered short term. So anything that is 7 years or 10 years plus, naturally, equity as an asset class does offer you uh, a fixed deposit beating returns because you're taking ownership in a company that generates cash, and that cash gets reinvested back in again. So think of it as ownership. Think of it that yes, you are an owner of that particular country, and of that particular business, and that has to be held for longer term, 10 plus years. That again funds for your retirement, right, or for your wealth creation. So you need to know how each asset class sort of what it is meant to do. So there is a comment, but I will take this comment after I'm done with the presentation. I think there's this couple of more slides, and then we can open the floor for Q&A. Right, understanding why asset allocation works. Now, this is a very uh, nice exercise. That every time whenever I have to think of asset allocation, I will always see this. Have a good look at this chart. Right, this is 2022, 2023 returns. For each, there is debt, there is equity. Within equity, there are different categories. There is international and there's real estate. Right. So have a good look at this. Uh, have a good look of what has done extremely well in the last 2 years. Right. So assuming you started investing in 2020, where would you invest most of your money? Where would you save? Where would you park all your savings? Is it gold? Is it small caps? Is it international? Is it going to be credit risk? Okay, somebody said small cap. Index funds. Okay. You can put any option even if it's not there here. Index funds. Okay. Multi-cap fund. Okay. So multi-cap means within that chart, it would be more large cap oriented because I think there is a good amount of large caps that is coming in into multi-cap funds. Large cap. Okay. B again, small cap. D again, small cap. Somebody said gold. Okay. Multi-asset allocation fund that has equal distribution of all asset classes, but hard to find such now. No, you're never going to find a fund that has equal in everything unless and until there's a proper mandate that's being set. Unless and until a fund that comes up says, yes, I'm doing this particular thing, there's rebalancing that's taking place. They set the rules that yes, rebalancing will take place every quarter or every 6 months. uh, and then you will find such a fund like that. But when you want to take advantage of something, naturally you open up boundaries. You don't set such stringent rules for yourself, uh, because you always have this fear of missing out, and every investor does have this fear of missing out. Yeah, dynamic asset allocations fund do have 60 to 80% in equity. Multi-asset does. When you're having a dynamic asset allocation strategy, uh, some cycles, so 2000 to 2010 cycle, gold did extremely well, and within equity, commodities, and infrastructure did extremely well. Okay. Naturally, at that point, if you're overweight on debt, you will not make much money. And then multi-asset as a category goes off because it doesn't make any sense for any investor who wants to save money go towards that particular asset class, right? Every cycle you have to consider it from a long-term cycle, and long-term cycles play out very, very differently. Like uh, again, for example, tech in one cycle for 10 years did extremely well, and global didn't do extremely well. So it takes a lot of time for long-term cycles to play out. Real estate did not do anything for 8 years, right? Within equity, right? But then, of course, things have to change. A lot of things have to take place. Gold again did not do extremely well, and then cycles keep changing because things keep changing. The economic environment is extremely dynamic. Things have to change. When things start changing, naturally you will see asset allocation also starting to change, right? But most of you said go with small caps. There were good answers that came large cap and multi cap. So now this is from 2018, right? If you start in 2020, you are not going to look at 2022, 2023 returns because that's not happened yet. You will look at 2018 and 2019. In 2018 and 2019, the top three categories that performed well were large cap, government GSEC, which is debt, and gold. Right. Then came international. Right. But 18 and 19 were debt years where corporate bond and GSEC did extremely well. You have not seen 12% sort of return coming in on GSEC in a long time. Right. Naturally, corporate bonds giving you 10% odd yield is hasn't been seen yet. Today's yields are somewhere around 7.8 to 8%, 7.7 to 7.8%. Right. So if you start in 2020, you are obviously going to look back because this is what we do. When we look at saving money, we always look behind and say, okay, last 3 years, this has happened. So next 3 years, this is what is going to happen. So I need to consider only the last 3 years and look back, like you have a recency bias. Right? You look back and only then take a call in 2020. But 2020, 21, 22, and 23 played out extremely different. Right? You don't see corporate bond somewhere on up. Right? You don't see large cap do well extremely from that. Right. So I'll ask you again, does your answer change then? Knowing that you started in 2020, seeing what has happened from 2018 all the way to 2020, right? Does your answer change that in 2020, if I start, I'm going to park my savings in that particular category? Does your answer change? No. Okay. Okay. So we have answers that say, no, I'm not going to change my answer. Okay, so no change in answer. Now look at this chart 18 to 23. Have a good look at what's doing well, what's not doing well. And again, we'll take a call on assume you started investing in 2018. Where would you invest? Right? Let's say you start from 2018. Is it going to be gold, small caps, international, or credit risk? Right? Which means you have to again look further back. Right? Where would you park your money then? Is it going to be the same asset classes, or is it going to be something else? Is it gold, small cap, international, credit risk? Okay, somebody said gold. Any allocation that should protect downside and stay less fallen during turbulence to weather the storm is key. Yeah. Asset allocation is all about making sure that you fall less. If you are 100% in equity, naturally you will fall either more than the index or slightly less than the index or very much than the index, right? Because it depends on where you are in that particular category within that particular asset class, like equity. Naturally, if you're going to have a bit of everything, then your fall will be much lesser, right? Okay. There is a lot of gold coming in. There's international. Yes, most MAF is 80%. No, most MAF is 75 to 80%. Some are 60 to 75% also, right? They have mandates. Mutual funds work according to a particular mandate, right? Amphi category, if you go to Amphi website and you see multi-asset funds category, they are allowed to do it. The regulator allows to have such rules to take place where the mandate says, yes, you can do 40 to 45, or you can do net 40 to 50, or you can do 50 to 60, you can do 60 to 65. There are mandates being set, and multi-asset definitely it's completely regulated. There are rules that are setting there are rules that are set in place, and all funds work according to a particular mandate. Likewise, again, cycles work extremely long. So in some cycles, when equity is extremely cheap, equity will be an overweight, where cycles in which debt and precious metals are uh, very much as an opportunity for you to take place, debt overweight and precious metals overweight will be there. Right? Yes, the industry of obviously will have some see when a multi-asset fund does not do well, right? You as investors in that particular fund, or let's say even 100% equity fund, when it is delivering somewhere around 15 to 18%, investors complain, right? Because that fund has done well, your fund has not done well, for example, to that particular fund manager. Why is it that your fund has not done well and everybody else has done well? Right. So if the language of investors and savers itself start changing, that yes, for me 12 to 15% works extremely well, because it is anyways uh, uh, making my wealth grow at a good pace, right? And that 2-3% for me does not matter. Naturally, the entire industry will change, right? Otherwise, you will be chasing equity. Every investor will chase whatever is the best performing asset class that's out there, and that's why this exercise is there, right? Are you going to chase the best asset class that's going to be there, right? A lot of you have said small cap, a lot of you have said gold, right? Small cap has done extremely well from 2018, but if you start investing in 2018 in that particular category of equity, your small caps in 18 and 19 did extremely bad, right? So somebody investing on 1st Jan 2018 and seeing that portfolio on 21st, sorry, on 1st Jan 2021, you've not made any money. Your CAGR will be somewhere around 2-3%, right? Naturally, you will start thinking that no, I think I made this mistake of going to this particular asset class, and then you will take that call on your own to say yes, I will go to another particular asset class, and then again that thing does not work for you because international and gold is performing extremely well at that point of time. So you enter at highs. So performance chasing is very important. Like somebody commented saying, yes, people are chasing. And as you see from 2014 all the way till 18, you see debt has done extremely well. along with international, right? Small and mid caps definitely have been volatile, but a lot of money has come in only from 2018 onwards, 17 and 18 onwards, where small cap as a category, investors are chasing returns, right? 40,000 odd crores has gone net inflow in the entire of last year, and 20,000 odd crores in the mutual fund space for mid cap net, right? Which is a lot of money that's going into these places. But if you check from 2014 all the way till 18, small caps have been extremely volatile, but debt has done extremely well, right? So every cycle, if you jot down 5 years, 5 years, 5 years, you'll always have a winner, a new winner, and always have a new loser, right? That's why we say that yes, you need to think of asset allocation in particular asset class. Naturally, you have to look at other asset class when you have to think of capital preservation and capital safety. Right. Now, again, I ask you this question. Does your answer change? Because from 14 all the way till 18, all gold investors did not make money only on gold. So for anybody who commented saying, yes, I want to invest on gold, 14 to 18, you never made any money on gold at all, right? 14 to 18, if you see back in value research or money control and you see gold did not make much money, right? It doesn't come, it's somewhere on the bottom. Large caps also don't make money. It has made money only in the 1 year, but then started to pick up as and when risk started to go up, right? So it was a majority of debt that did extremely well in one particular cycle, right? If you see from the long-term cycle and you see short-term cycles that come in, different asset classes will perform differently. So naturally, in that particular point in time, right, all your multi-asset allocation funds would be overweight on debt and be underweight on equity, right? So now I ask you again, is your answer going to change? Does your answer change if you see this long-term data of 10 years and let's say you started investing in 2018, does your answer change? Honest, yes. Okay, I appreciate your honesty. You said yes. Yes, fantastic. Yes, I appreciate everybody's honesty that's coming in. Right. So the signs are there that every cycle that comes in, you can look at signs, right? When there's over optimism that's coming in on one particular asset class, naturally you have to start looking towards other asset classes to park your money and to park your savings, because you are here for a long-term goal. You are not here to take advantage of 1 or 2 years, right? It's like test cricket. You're there for 5 days and you have to last for 5 days. So your mentality has to change. Your mentality for 5 days staying on the grease day in and the entire day has to change. It's like test cricket. Right. Now, this is the entire asset allocation quilt for the last 13 years. 10, 11, gold did extremely well. 10, 11, 12. After that, we had issues. The country also was going through a very turbulent time. Naturally, everything else did very well. But if you see this as an investor, you get so confused. You as a saver, my God, there are some cycles that did extremely well for some particular. So do I need to chase? Right. This is where most investors get trapped when they have to think of asset allocation, right? Is because you are not looking at your need and you are not looking at your time horizon. As a saver, you only need to look at two things. One, that yes, I'm continuously saving my money and I have to park that money based on my particular goal that fits for me and not for somebody else, right? Somebody else's needs are not your needs, right? So most investors rely only on past performance to make investment decisions. They always look for some sort of validation. They always want to look for evidence, right? But the evidence is right in front of you. When there's overheat, when something is extremely optimistic, when investors are becoming a lot more greedy. Today, everybody on equity wants a double, right? Everybody wants a double or a triple because they have seen that evidence coming in, and most investors that have come in, the average age of that particular folio is just 2.5 years old, which means they are all new investors who are coming in. So the expectations is being set itself is wrong, right? So you as an investor, as a saver, right, you need to set the right expectations for yourself, saying that yes, for me, if I follow this particular process, 9 to 12% sort of is the best way for me to think of saving wealth in India, building wealth in India, right? Whether I follow, while I follow multi-asset sort of approach, right? So studies have shown that investors' effort to outguess the market by jumping between asset classes results in underperformance, right? So if you see performance chasing CAGR for 13 years, because we are all long term, is just 7%. But if you just do equal weight, right? When somebody said, no, we need to have an equal weight strategy in all asset classes. What does an equal weight strategy do? Right? You're protected during the downside, you make money during the ups. When upside comes in, no money comes in, also still one particular asset class will do very well. Right? If you look at equal weight has done somewhere around 9%. So that's a realistic expectation for you to have from a long-term perspective, that if I follow equal weight also, I'm still having a 9% or sort of return, which is more than my FD, which is more than GDP growth that's coming in. Right. So why is it that you have overweight on one particular asset class? If you've seen cycles and you know how cycles are going to work, naturally you can take advantage of that particular asset class and take slightly more risk by making sure that yes, I'm very well protected on all my other asset classes where my downside is protected, and still be able to do 11 to 12% or 11 to 13% sort of return. Right. So always look at your needs. Don't look at past performance. Don't look at returns that are coming in. Always look towards what your need is. If your need is that, yes, I need to be a little safe, then naturally your temperament has to change, right? You can't take if you have a goal that's coming up in 2 years, you can't take a risky asset class like equity because it's volatile. You're seeing prices go up daily, up, down, your BP is going to go up, right? So some asset classes work for particular goals. Use those asset classes to make use of that particular goals and set expectations right. Asset allocation is all about doing what's best for you and setting the right expectation. Right. When do you rebalance? You rebalance only when your goal is met or there is extreme optimism in a particular asset class. Right. So if you see from this big chart, debt did extremely well and gold did extremely well for 6-7 years, right? After that, your gold has continued to do well, and your debt has not done well. Right? There was a point where real estate did very well, and now then, because of over inventory that came in into the entire real estate side, and uh, they had bloated balance sheets. There were no new projects coming in. There was no appetite to take on real estate. Right now, you are seeing inventory starting to come down and new projects being announced. So naturally, this is a very big sign that yes, the country is growing very well. Pockets are being filled. Naturally, that goes on to uh, it keeps going down, right? It's a ladder effect. It'll keep going down, right? So this is only when you rebalance, when you are very near to your goal or your goal is being met. And second, if you're in for the long term, always make sure that you take advantage of over optimism and under optimism. You go towards when there's under optimism and naturally take advantage of over optimism. Right now, I'll open the floor for Q&A. We have a good 10 minutes or so for Q&A, and whatever questions that you have, please put it in the chat box. So there's a question on we pay premium to protect capital loss, right? We can't be just running only behind returns. It's risk adjusted returns what matters. Yeah, multi-asset is giving risk adjusted returns only. See, if you're having so much of reservations towards equity or being overweight towards equity, right? Then your asset allocation needs to be more on debt and precious metals and not on equity. So, we can construct a particular portfolio based on your needs, based on your goals that is coming up, where behaviorally we will be able to handhold you in terms of how you should think of a particular asset class, what you need to do when you look at this particular asset class, how you need to uh, channel your savings towards that particular asset class. We can definitely help you. But saying that this mutual fund is not doing, uh, uh, they are overweight and then they don't fit my risk profile, then please do not go towards that particular product because it does not fit your risk profile. What's our current multi-asset allocation for our fund? Overall, in our multi-asset allocation PMS, from an overall perspective, we are having 80% into equity and new. So every portfolio that we are building is completely different. So the number that you're seeing is more from a legacy side, right? Where we overweight on equity between the 21 and the 23 years, right? Where we were able to build into these businesses, right? because we are taking advantage, because it's dynamic, all the new portfolios that we've been able to build in the last 4 months are overweight on debt. So equity component is only 35 to 40%, 37. That's only in terms of equity allocation that's going in. The rest is cash, debt, and precious metals. So that's where new portfolios are being built because opportunities are different, right? And for us, we understand that the investors that we're working with on the PMS side for multi-asset, they have a retirement goal in place, right? So we have a long horizon when we work with those investors, and we are able to take advantage of asset that we are able to take advantage of opportunities that's coming up in these particular asset classes, right? So every time anybody comes on board, their portfolio is being built different, not only on our multi-asset PMS, across all our PMSs, right? Be it small cap, be it large cap, be it multi-cap, that is flexi cap, and be it multi-asset, right? It's based on that particular opportunity. If it gives us that opportunity to go overweight on a particular, in the multi-asset space, go overweight on a particular asset class, then we naturally take that call, right? So last 3-4 months, the portfolios that we have been able to build, they are completely overweight on debt and precious metals. There's some global also that's there, that is because valuations are extremely conducive on that particular side, right? Next 6 months, what is the best instruments to park? Please stick to your savings account. Don't try to make extra return. Settle for low. Settle for lower. Here also equity, LOL. Thank you for sharing. My question may be basic. No, I don't consider any question to be basic. How can small retail investors buy bond? See, the ticket size for bond is 5 to 10 lakhs. Some bonds are 5 lakhs, some bonds are 10 lakhs, right? If you want to buy a bond, uh, you need to understand that debt is not a broker market, right? It's a dealer driven market. Equity, on the other hand, has a proper exchange which you can go see price, uh, uh, feel happy that yes, it's going up, going down, and then get excited. But bonds are, and debt is not like that, right? Debt is a dealer driven market. If you buy a particular bond and you want to sell off, right? Don't trade a bond. Never trade a bond. It's meant to give you income. Treat it as an fund only, right? Uh, So if you have 5 to 10 lakhs with where you say that this is something that I just want to make income of, and if it suits your tax needs, only then go for a bond. Otherwise, don't go for a bond. So we have options if you are interested on the bond side. I'll put in the number and you can just send a hi with your requirement, and somebody from the team will get in touch with you. Is it possible through DMAT? I have to check. It is possible through Demat also, because on the exchange you can buy bonds and sell bonds. But yeah, it is possible. But I still have to check that. But from my understanding, that yes. Does it have any lock-in? Yes, it has lock-in. It is based on the maturity. Yeah, it is based on maturity. Some are perpetual bonds, and but it has to be only based on maturity. Like then when money is needed, should we sell? No. That's why bond is not meant to meet your liquidity. It's meant to meet your income needs. Liquidity needs, where you choose savings, or you choose a debt mutual fund. A debt mutual fund, ultra short or a low duration fund for your liquidity needs will work well. Settle for 7.5% return, and it'll be fine. Bonds today, AAA, I don't think you can get more than 8 or 8.5 or something like that. That also is on the somewhat on the higher side. But if you have liquidity and you need something where you need money, stick to a debt mutual fund. Don't go towards a bond. How do you invest in global? You can invest via mutual funds. You can invest via ETFs. Mutual funds, if it's open and they have not met that cutoff, the AMC has not met the RBI cutoff, then naturally you can do via mutual funds. Based on my opinion, the real estate will be stagnant till 2030, as it ran up towards too much in the last few years. So it's a good time to exit real estate and move to other asset classes. Are you talking about stocks, or are you talking about properties that you bought? Uh, I'm sorry, I'm not the right person to answer property. Uh, Maybe I can get you in touch with the planning team, and maybe they'll be able to tell you as to what you can do in terms of your. Are you staying there? Is it something that you own where you're getting rental income? This is based on your needs. I think a one-on-one conversation would work. So I think you can just send a hi, saying that yeah, I had asked the question on the webinar regarding real estate, and we'll redirect you straight away to the planning team. Is dynamic asset allocation pro-cyclic or reverse? Because a few say when markets are high, equity allocation must be high, and vice versa. But another view is opposite. So much is because of two schools of thoughts. This is not two schools of thought. There are multiple schools of thought. Right? Some are. That's why some styles work. Momentum is one style. Contrarian is one style. There are many styles. Right? If you say pro-cyclical, every fund has to be pro-cyclical only. Nobody is going to go against growth. Right, everybody is going to go towards the only reason of why people want to park money in equities and research because it's growth, right? And if you say you're non pro cyclical, which means you're against growth. So obviously people would go towards growth. Everybody wants growth, right? So there are many schools of thought. Dynamic asset allocation is only such that we will not stick only to one part of growth. We will try to take advantage wherever we can. Arbitrage fund, money market fund, multi-asset fund, which one is good for short term? Arbitrage and money market is good. We are now starting to, I will do a webinar next month on arbitrage funds, but on Milestones to Wealth, if you're on the platform, get onto the platform, you'll know what we are doing with short term, ultra short term, and arbitrage, where the opportunity lies. Where should an investor with that particular need of say 1 to 2 years park their money, which is the best option for them to do. So right now, money market and arbitrage are offering good opportunities. But ICICI Pru BAF says the way says other ways to they keep less equity in high markets and do reverse. Yeah, BAF ICICI BAF works extremely well. They're doing a phenomenal job. The fund is only 54,000 crores. So long way to go for that particular fund. So if you are having this sort of I don't want too much of volatility on equity, but at the same time make 9-11% sort of return. BAF works well for you, especially for you. BAF works well. No, they are pro-cyclical only, right? They are still taking advantage of one particular asset class in the cycle. That's why when I showed you the chart of cycle, I told you that yeah, some that asset classes are going to be in different stages of their particular cycle. So they are taking advantage of growth coming in on one cycle, right? On one particular asset class. So they are taking advantage of growth. So I think I have time for another one or two more questions. So whatever questions you have, please put it in. Send us a hi if you're not on the platform. Somebody from the team will get in touch with you regarding what your needs are. Milestones 2 Wealth is a completely behavior-oriented program, right? It will only help. It will help you out in terms of how to look at your needs and how you should, what sort of direction you should take in terms of your needs, right? We will help you out in uh, making you understand what the right asset allocation is for you regarding your particular need. Everybody's needs are different. So based only on your particular need, our objective is to help you create a savings habit, right? Which in turn will help you manage your investing habit, right? So it's a completely behavior oriented program. You guys only handle your PMS. Do you guys also have your own funds? No, we don't have our own mutual fund. PMS and distribution for mutual funds. Expected return for the next 3 years. Please look at my gold webinar and then you'll know. Yeah, MFP, ARN. Yeah, we have an ARN. We have another arm. Like Milestones2Wealth comes under that here. This is more from a mutual fund perspective. AMS comes under, it's a different company altogether. No? Regular plans only, yes. No direct. Direct, we are not doing. We had an RA only service, but RA becomes very, it became, from a regulation standpoint, became very difficult to operate. We were managing around 400 crores in the entire direct space, 415. We shut that service and returned the money back to our investors. Expected return for gold, please gold webinar. I've done two webinars. I'm planning to do one more webinar next month regarding gold alone. So do look at that also. So you'll know what the expected return is for the next 3, 5, 10 years also. That you'll know. Yeah, ticket size is 50 lakhs for PMS. It's SEBI regulated, so SEBI says 50 lakhs, so 50 lakhs is the minimum. No, we do not have AI. Okay, I guess there are no more questions. So thank you all for joining in on a Saturday afternoon. Hoping to again see you all in the next webinar in this month. Have a good weekend, and I'll see you guys next week. Thank you. And next week's webinar is more on the banking side. It's on equity and banking and what we can do on banking. So do join in on that webinar.